Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And believe it or not, it's been yet another quarter, and we have our Chief Investment Officer from Nassau, Mr. David Czerniecki, back with us. David, how are you?
I'm doing well, Paul. Thanks for having me back.
You know, it's funny. This seems like yesterday, but it wasn't. Although they're same themes, keep coming up in just different forms, different, different patterns here over the last year or so. So maybe we just dive in. I'm going to ask you. So I'll ask some hard questions, which I think are impossible to answer, given how quick the news changes. But I couldn't start the show without saying tariffs. Like, how do we think about these?
Right. Well, so let's dive in a little bit, Paul, and we'll do the best we can under the circumstances. You joked about being back here so quickly. It's been a bit like going over Niagara Falls in the barrel since the start of the year, for sure. And it is a very difficult environment. We joke in our business, Paul, that the hardest time to invest is always now, right? And I think we're seeing that in evidence here. So tariffs, okay. So obviously we don't know what the tariffs are, what they will be, how long they'll last for, whether or not they'll be anything material or not. But as much as there's been some whipsawing and seesawing, and the markets are reacting to that, I would also say that we saw from the first administration that there is some seriousness to this, and that our president and his administration are extremely competitive bunch. And I think there's a desire to use what I think Teddy Roosevelt, referred to as the big stick diplomacy. But in this case, the big stick is our checkbook. And so I think there's a lot of leveraging of the strength of the U.S. economy to try to sort of, I don't know if level the playing field is the right words for it, but to sort of interact on an international basis in a different way than what we have been. So, a little bit we'll see what happens. Of course, the benefit to tariffs, and the intended benefit, at least as we're talking about, is behavior modification. In some instances, it's about bad things like fentanyl and stuff like that, and trying to gain some leverage. In other instances, it's about jobs and manufacturing in the U.S. And probably other things as well. But with all that as a backdrop, to the extent that, what we have to think about is sort of the economic impact in the near, intermediate, and longer term. In the near term, the first thing I'll tell you, Paul, is markets are always more volatile, and sometimes a lot more volatile than the actual economy. When you think about the U.S. economy over the long haul, we sort of cycle between things being quite good and things being not so great. If you watch the markets during those same cycles, we cycle from things being cataclysmic, right, and Armageddon, to perfect and the sky is the limit and no price is too high. So the markets will tend to overreact to things. If the tariffs are put in place and held in place and are successful in changing the way, the route of trade, if you will, and in the volume and bringing manufacturing home, that's a many, many year build. In theory, the equity markets would price that in, but that's a long-term build. Ultimately, I'd come out in the camp of they're inflationary. You have let me pause for a second. Keep in mind that inflation, as it's sort of defined, and I don't have it up in front of me, is a sustained increase in prices over an extended period of time. A one-time pop in something is not what one would consider to be inflation. You and I feel it, at the store, but in reality, it's the compounding effect of inflation that's so dangerous. And so if you have this one-time price adjustment, you usually end up with a supply shock or a demand shock to sort of react to it. It's the same thing. So if tariffs stick and they're out there, you're going to get this one-time pop in pricing. Do they go up again next year and the year after and the year after? The answer is probably no. So you don't really get sustained inflation, but you do have a move up in prices. You have a move up in prices, in particular for manufactured goods, which hits the middle and lower class a lot harder than it hits the upper class. But but ultimately, I do think they're inflationary. If they're successful, let's say, in moving manufacturing home over a number of years, we know that our cost structure is high relative to some other parts of the world. So you are kind of building in some inflation there. Now, technology will help. I'm sure we'll talk about that. We always talk about that. And so that may be an offset. Let me give a quick example, Paul. If you go back to the financial crisis, everybody talks about the markets and mortgages and banks and stuff. Let's not forget the auto manufacturers felt it pretty hard back then too. And auto sales plummeted. The auto industry came back pretty strongly. And in not too long a period of time, they were producing just as many cars as they had been, prior to pre-crisis. They were doing it with 40% less employees as technology took hold. So there are, there are efficiencies. I don't know, Paul. In my personal opinion, this is not the opinion of the firm. It's a negative. I'm a free trader. I believe you let markets flow and capital, go where it needs to because that's what's most efficient. This is sort of getting in the way of that. So from that standpoint, as a markets practitioner, I view it as a negative. As a geopolitician, I'm out of my depth, and there are geopolitics involved here.
Oh no, clearly, and I think you make a lot of really interesting points. You mentioned a little bit about inflation, and we didn't see any cracks yet. The eggs seem to be the latest barometer. I mean, will the price of eggs be a political barometer? I don't think they're. In your words, I think it's an unusual increase based on bird flu. I mean,
right. You have it. Yes, Paul. I think to answer your question, I think will the price of eggs be a barometer? I think in the papers and on the news, absolutely. I think in the sound bites and the social media, absolutely. Everyone will keep throwing that up as a bad thing that somebody else made happen. But the reality is, I can tell you that the Fed could give a hoot about the price of eggs.
They wouldn't give one cluck.
I'm being a little bit cavalier, Paul. But the truth of the matter is, when the Fed looks at inflation, it actually looks at what's called core PCE, personal consumption expenditure. That excludes food and energy because those prices are so volatile, and people will find substitutes. Take meat, for instance, right? I like my weekly, egg sandwich, right? The one that I swear to everybody, so please don't record this, Paul, that I don't eat, all right? But you can tell that I do. All you have to do is look at me. So I'm going to have to factor that out of my budget now, which is good. I'm better off, right? I save a little money, and I'm probably helping my health here. But you find substitutes, and eggs are not actually easy to substitute for. But things work themselves out in those kinds of things. So that's not the harbinger of inflation. Look at the PCE numbers. Look at the overall numbers. Look at the cost of manufacturing, cost of goods sold. Look at this. Don't forget, Paul, we're a majority services economy now, and service prices have been pretty sticky.
Yeah.
So we still have a headwind. We still have a headwind with inflation. The job of the Fed is getting harder because they would like to keep rates where they are. I think that's kind of what they're saying if you read between the lines, and continue to sort of try to solve that problem. But as the economy gets more volatile, they have to be worried about something breaking and then needing to kind of rush in to solve that problem. So, it's definitely the path that they're walking along has gotten a lot thinner, and it's not quite a tightrope yet, but it's a pretty narrow balance beam they're on.
Right. Okay. Another topic we've discussed. I think you rightly so given me a few eye rolls in this one, but cryptocurrency and Bitcoin. We now have a crypto czar, David Sachs, very knowledgeable, very tech forward guy who will lead into the second question in a little bit here. But David, I just thought today, this will, we'll get the show out quick, that we actually are now going to have a Bitcoin strategic reserve. What is that?
I don't know. Our strategic reserves are, to the extent that I know which ones exist, right? And I think we all know about the petroleum, the oil strategic reserve. That dates all the way back to, I guess it was the late 70s, early 80s. I guess it was after the oil crisis when you could get oil again. We created a stockpile in case something like that ever happened again. And I think there are other things that the government keeps in sort of close control over, or close quantities of, just in, as a just in case kind of thing. What our need for a strategic reserve, given that we don't use Bitcoin to sort of settle our debts or, manage our international trading and flow, I'm not sure. To me, it smacks a little bit of speculation in it. But again, I don't work in the government. I still think you're dealing, from an investment perspective, it's not something we plan to put in the portfolio anytime soon. I think you're dealing with a highly volatile asset that is, it's difficult to predict the value of, because you're a little bit dependent on the greater fool theory. Paul, when we invest the portfolio, and we do here, one of the things I like to say to everybody is, and this is a bit of a truism in the world of finance, is I have cash flow, therefore I am. And we look for cash flows. We look for a measure of what something will be worth by virtue of what it can produce in terms of income, cash flow, earnings, present value of these things. With Bitcoin, it's a highly volatile asset. People use gold as a store of value. That's the other name for that kind of thing. And, gold has proven over, many, many centuries, right, to be a store of value. And people, still mine for it in the world and stuff like that. People are mining for Bitcoin, of course, but it's even hard to see it today as a store of value. So, does it have a place in a very highly speculative portion of your, sort of personal portfolio? Yeah, maybe, if you've got the chutzpah for it. In the portfolios at this insurance company, it's way too speculative to be putting what I call, other people's money into.
Yeah, I do find the stable coin initiatives that are going on to be kind of interesting, because as this currency starts to play, does that take friction out of the foreign currency exchange market? But that'd be a whole nother topic that I'm not even ready to talk about. But so David Sachs is not only the crypto czar, but also head of the AI initiative. David, you mentioned these Bitcoin mining operations. I've actually heard the mining operations are turning some of their data centers into AI centers now, because what's going on. What's your take? Trends. I mean, you've been very optimistic, kind of long-term bullish, on previous calls. Any changes in your outlook on AI?
I still think it's a long-term productivity gain. There are things that it can do. There are things that it can't do. There are things that it can't do today that it may be able to do tomorrow. There's still a lot of things that, we're a long way away from sort of a human substitute. But it's hard not to envision a degree of improved efficiency, productivity coming from this. I mean, you think of all those sort of simple applications you can kind of, cook up in your head, whether it's, getting your meal, again, going back to my egg sandwich, getting my egg sandwich at McDonald's, it's just getting easier and easier, right? This is a bad trend, Paul. I keep running into here. But, so, you're going to see continued improvements in the way things are done and the way things are managed. Somebody, I think I might have said this to you before, Paul, when somebody said to me, at a minimum, AI has a PhD in mediocrity. Like, it can do a lot of simple things really, really well and very cost effectively. So you're going to see it continue to penetrate, but it's a slower burn. What you're seeing now is sort of a front end investment from organizations and companies and strategies that you don't want to miss the party. You don't want to be late to the party. That's thing one. You're also seeing some of those is particularly some of the big organizations that have invested a lot, looking at the long term trend, and they can afford to invest a lot, to sort of get out in front of that and help direct it. In what I'm sure they all hope is to their benefit, i.e., that they're a winner in all this. Whether it's a Microsoft and Apple, or a Meta or whatever, right? They compete with each other, and they want to be competitive. They want to win. So you're seeing a lot of that. So I think you have probably a bit of a bubble and kind of demand for everything that's there. But I don't know, Paul, I've said this before. It's a bit like the internet, and we saw that movie. And I think this movie's probably running at a little bit higher, frames per second. But it's hard to imagine where it doesn't improve efficiency, and that we're not all using it for some things at some point down the road here.
Right. No. Listen. It's changed my world.
Right.
In probably every aspect. But no, it's interesting, and I think the CapEx expenditures in this country, are amazing. Now, CapEx. If you're making those kind of capital expenditures, you need to see the returns. How long does it take, and
right.
when, and are we going to see some crashes? I'm sure we will. I'm sure we will over the next couple of years.
Yes, but, and Paul, we know that this is not an uncommon thing in markets and in investing and in strategy and things like that. It's the old thing, right? Too much of even a good thing can become a bad thing. So
right.
You'll get excesses for sure.
Yeah. Okay. All right. Well, listen, David. Thanks for your time. I guess if you look back at the quarter, I mean. I won't ask you to look forward. Looking back, from an insurance perspective, bond portfolio, interest rates, good, bad. Was it positive for the industry?
I would say, it sort of falls into the camp of fine. What we've seen in our investment world, the stuff that's supporting annuities, is that rates have continued to hang in there. I mean, they've come down a bit, right? We're at the lower end of what I consider to be kind of a trading range. I think the direction is still more likely up than down from here, but again, not wildly up. And I think some of that depends on, continuing to avoid a recession. If that were to happen, then I think you see rates come down quite a bit. And so you've got coupon. Most of that coupon is coming from what we call your base rate, i.e. your treasury rate. Spreads have become very narrow, very tight across the board. And so, what we, and I'm sure plenty of our peers are doing from from an investment perspective is, if you're not getting paid a lot more to take more risk, you tend to move up in quality. And with spreads fairly narrow. Now, why are spreads narrow? Well, I think there's a couple of factors. Up until very, very recently, I think most people's outlook for the economy was quite good. And so you get paid less of a risk premium when, the expectation is risk is low, or risk of a problem is lower. So that's thing one. I think thing two is that you still have a pretty hefty imbalance of supply and demand in the fixed income markets. In other words, there are huge portfolios out there that are owned by insurance companies and everybody else, right? Pensions, et cetera, that throw off a lot of cash in terms of coupon. That cash has to get put to work, and it's going in to buy more fixed income. But there's less issuance. There are fewer public companies. Companies don't need as much debt. The companies that are making huge CapEx investments are companies that are highly profitable, highly cash generative, so they're not borrowing a lot. Manufacturing, as we talked about earlier, is less prevalent in the U.S. That tends to be a big CapEx spend, which again requires a lot of debt, right? Borrowed money. So you're getting less demand for that. So you've got this money, this kind of wall of money looking for a place to go, and there's not as much to buy. I think if deal activity picks up, and most folks expect that because we expect a little bit lighter touch on regulation, you may see some more borrowing and you start to get a little bit of a better balance, but that hasn't happened yet. And I think while all this global positioning is going on with the tariffs on and off and on and off and on and off, I don't know where we're at right now. I haven't looked in the last 3 minutes, but if deal activity picks up, you'll see a little bit better balance there.
Yeah. All right. Well, listen, thanks so much. Look forward to Good luck on another good quarter. And
Thank you.
we'll enjoy having you. Thanks to our listeners. Join us again next week for another great episode of That Annuity Show. Thanks.
Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com.